Hi, my name is Kele Ubem from ARM Investment Managers. In this video, I will be walking you through some of the major market events in the month of September. Precisely, I will discuss some macroeconomic indicators, the performance of the stock market, and the performance of fixed income markets. In the most recent inflation data released by the National Bureau of Statistics, inflation fell in the month of August to 20.12% year-on-year, down from 21.88% in July. This marked the fifth consecutive decline in 2025 alone. On a monthly basis, consumer price index rose by 0.74% in August, lower than 1.99% recorded in July. Again, this reflected a moderation in short-term price pressures. Furthermore, food inflation and core inflation also declined. For context, food inflation fell from 22.74% in July to 21.87% in August, while the core inflation dropped from 21.33% in July to 20.33% in August. Overall, the declaration was attributed to the drop in food prices such as rice, flour, millet, semolina, and vegetables, given the sustained harvest season. Looking ahead, we expect the moderation in headline inflation to be sustained in September, supported by increased food supply. In addition, the stability in exchange rates should continue to ease price pressures on imported goods. At the MPC meeting in September, the committee voted to cut the monetary policy rate to 27% from 27.50%. The committee also narrowed the asymmetric corridor to 250 basis points minus 250 basis points around the MPR from 500 basis points around the MPR. The committee also lowered the cash reserve ratio for commercial banks to 45% from 50%, while retaining 60% cash reserve ratio on merchant banks. The committee also introduced a 75 basis point cash reserve ratio on non-TSA public sector deposits. Lastly, the committee maintained the liquidity ratio at 30%. Looking ahead, with expectation of lower inflation as food supply improves, more stability in exchange rates, and dovish cuts from major global central banks, we expect the committee to remain dovish at its next meeting, scheduled to hold on the 24th and 25th of November 2025. And on the final macroeconomic indicator, which is the gross domestic product, Nigeria's economy grew by 4.23% in Q2 2025, highest since 2021, as reported by the National Bureau of Statistics. Notably, this was the first quarterly GDP growth rate, which exceeded 4% since 2021. This also marked an improvement from 3.48% year-on-year growth recorded in Q2 2024 and 3.13% year-on-year growth recorded in Q1 2025. On a quarter-on-quarter basis, the real GDP grew by 3.77% in Q2 2025. Decoupling the data, Nigeria's oil sector recorded a strong year-on-year growth of 20.46%, significantly higher than 1.87% and 10.08% recorded in Q1 2025 and Q2 2024, respectively. This was driven by higher crude oil output of 1.68 million barrels per day, up from 1.4 million barrels per day in Q1 2025 and 1.62 million barrels per day in Q2 2024. The non-oil sector remained the dominant driver of Nigeria's GDP, contributing 95.95%. The sector grew by 3.64% year-on-year, higher than 3.19% in Q1 2025 and 3.26% in Q2 2024. Now moving to the Nigerian equities markets. In September, Nigeria's equities market sustained positive sentiment despite some profit taking observed during the month. For context, the Nigerian All Share Index gained 1.72%, while market capitalization rose by 2.04% to 90.58 trillion naira. Overall, the market returned 38.65% year-to-date in the month of September 2025. Across the sectors, likes of the consumer goods, industrial goods, and even the oil and gas were positive, while the banking and insurance closed slightly negative. At the September FGN bond auction, the DMO offered a total of 200 billion across instruments with subscription of 1.26 trillion. Demand was robust, with average bid to cover ratio surging to 6.3 times from 1.3 times in the previous auction. Consequently, the average stock rate moderated to 16.10% from 17.97%, reflecting a sharp reversal in yields. Overall, a total of 576 billion was allotted at the auction. Now on our outlook. For the equities markets, we expect to see a mixed sentiment in the next months. This will be shared by profit taking on the recently rallied stocks and of course anticipation for the earnings results of major banking names. In the fixed income space, we expect yield to decline as robust liquidity and impact of the recent 50 basis point cuts by the MPC should continue to impact the markets in the month of October. Thank you for your attention and engagement. As you navigate the markets, remember, staying informed and focused on the long-term value is a timeless strategy. We remain invested in your tomorrow.